Welcome to Bearbull, where you will learn everything about accounting and finance. In this video, we'll be learning about financial accounting, and bear with me for 40 minutes and you will be in a good position to learn everything from start to end about what financial accounting is and what are the basic themes involved in it. So let's start. Okay, first we will talk about forms of organization. Remember that when whatever business you want to start, for example, even if it's a trading business, it's a manufacturing business, it's an import export business, there are three ways in which you can structure your business. Number one is sole proprietorship. And in sole proprietorship, there is only one owner and there is unlimited liability of the owner. For example, what does this unlimited liability means? It means that suppose the assets of the business are not enough to settle all the liabilities of the business, then the owner will have to pay those liabilities from his pockets, his personal state. So even the owner might have to sell his own house to settle those business liabilities. So the liabilities of the business are not restricted to the capital of the business alone. They extend to the owner's personal property also. Second mode of business in which a business can be organized is partnership. Now, in a partnership, there are two or more owners. And remember, minimum it's two, but maximum there's no limit on it. And in partnership also, there is unlimited liability. Number three is corporation. A corporation or a company is a business of organization in which there are many owners called shareholders, and each shareholder owns a specific percentage of the company based upon the number of shares he owns out of the total shares issued. Now, the biggest advantage of a company is that it has limited liability. What does this mean is that if the liabilities of the company are more than the assets of the company, then the owners, individual owners, can't be asked to pay those liabilities out of their pockets. They are only liable to the extent of the investment they have made in the company. Now, companies can be both listed on and non-listed. Listed companies are those which are registered on the stock exchange and whose shares are bought and sold in the secondary market, that is, in the stock market. Whereas non-listed companies are those which are not listed on the stock exchange and their shares can only be traded privately by the individual owners. Moving on, when a business has unlimited liability, this is an MCQ for you. Okay, you can just pause it and solve it also. When a business has unlimited liability, the owners cannot lose more than the amount invested. No, this is wrong. A is wrong. The investors are not personally responsible. Wrong. Number C, the owner's personal assets cannot be taken if the company's assets don't cover all the debts. Wrong. So the correct option, it seems, is D. The amount the owners can lose is not limited in any way when a business has unlimited liability. So let's move on. As you can see, the yellow answer, which is D. So types of business activities. What does a business mainly do? What are the core functions of a business? So the core functions of a business are financing, investing, and operating. Now, financing activities means it's all about raising funds from where the business generates funds. For example, if you want to buy some assets to carry out the business, for example, if you want to buy the machinery, then from where you will finance that particular cost of the machinery. Either you can, of course, there are two ways. Either you can issue your share capital or your own personal finance in case of individual and partnership, or you can acquire the loans from the banks. So second activity is investing activities. This is where you buy capital assets. Okay, you can buy building, land, equipment, which are essentially necessary for the third activity, which is operating activities. Now, operating activities is the core activity of the business. This is selling goods. Okay, now if the purpose of the business is to import and export, then imports and exports are the operating activities. If it's manufacturing, then manufacturing is the operating activity of the business. So operating activity is what essentially the business is all about. It is the core activity. So MCQ, when a company sells their old equipment, it would be considered as operating, investing, financing, delivering. Of course, I told you that when a company buys capital assets and equipment, buys or sells, remember, selling is also part of selling capital assets is also part of investing activities. So the answer is investing activities, as you can see. So, internal and external uses of accounting information. Now, why do we prepare accounting information or financial statements? Because there are various external and internal folks who need to make decisions, who actually make decisions based on these financial statements. Now, the first of all, there are tax authorities. Now remember, these are the external uses. I'll be talking about the external uses of accounting information or financial statements. Tax authorities need accounting information to ascertain the correct profit of the business, because based on that profit, the authorities determine as to how much tax the business is liable to pay. So these are also the external users of accounting information, which are essentially customers. Customers need to know what products the company plans to launch in the future. Financial analysts need to know about, as you can see, the third one, and they make projections about a company and see if in the future the company is going to be more profitable or not, and based on that they recommend their clients to purchase more shares in the company. And if the of course the company's future outlook is bleak, they might tell their clients to sell their shareholding in the company. Now, regulatory agencies make sure that the company is not involved in any monopolistic activities. For example, competitors, of course, need to know. They scrutinize the financial statements of a company in order to know what are the strengths of that particular company, what are the weaknesses, and they might also want to acquire a certain company because of its critical assets. For example, if a company has key contracts or sole contracts, then a competitor might want to acquire it. Now suppliers want to know about the company because they sell their products to the company on credit basis, so they need to know if a company will be able to pay back in time. Now, current and potential owners, of course, by owners we mean individual owners as well as shareholders. Now, shareholders decide whether to purchase or sell shares based upon the information in the financial statements. Banks, of course, need to know the credit worthiness of an organization, and by reading the financial statements, they are in a very good position to know as to whether the company will go on as a going concern, or whether it will have difficulties in surviving. Now, internal users are essentially the management of the company. They need to know what went wrong if the company's profitability has declined. They need to know what are the areas where the company can improve. So management uses the accounting information in a host of ways. Okay, let's move on. Which of the following primarily uses accounting information to determine whether the company can pay its obligations? Number one, shareholders. Number two, competitors. Number C, creditors. And number D, tax authorities. Of course, the answer is creditors, because they need to know whether the company can pay its obligations. And if the company is in a position to pay its obligations, then they will be able to lend the company more. Now, what is accounting? Let's jump on to the basic question. Accounting is a system and process for identifying, measuring, and analyzing and summarizing, reporting economic information about an entity, so that, and of course they need to communicate the same, that economic information about an entity, which is in the form of financial statements, to the various users, which are external as well as external. And why? Because those users need to make decisions, and the decisions we just talked about are various in nature. So how the information is communicated? Through financial statements. So remember, accounting, in an accounting, first we identify the transactions as to what constitutes a transactions, and then we measure and assign a value to a particular transaction and analyze it as to under what account that information needs to be recorded. Then we summarize all those transactions and report those transactions in the form of financial statements, so that various users, both internal and external, can make decisions. So, talking about financial statements are essentially reports from management to the external users which summarize how the company performed during the period. They attempt to capture financial information about a company so users can make informed decision making. Remember, financial statements, the primary purpose of the financial statements is to allow the users, both external and internal, to make informed decisions based on the performance of the company over a period of time, which is usually 12 months. So, financial statements are basically income statement and statement of retained earnings and statement of cash flows, balance sheet, balance sheet. And so first we talk about income statement. Now, income statement reports the results of operations for a specified period of time. Remember, it's about a period of time. Generally, it's 12 months, but the listed companies also need to prepare quarterly financial statements. So, income statement contains revenues of the business, expenses, and the net income, which is arrived after deducting expenses from revenues. Second financial statement is statement of retained earnings. And statement of retained earning reports the changes in retained earnings for a specific period of time. Remember, period of time. For example, this is also about 12 months. So it basically starts from the net income or statement of accumulated retained earnings of the previous year. Then we add net income to those retained earnings, and then we deduct dividends paid in the current period, and we arrived at the statement of retained earnings. We will talk about this in detail later in this lecture. And the third financial statement is balance sheet, and balance sheet reports the financial position at a specific date. Remember, previous statements were about a specific period of time, and balance sheet is about a specific date. Now, it states what are the assets, what are the liabilities, and what are the shareholders' equity of the company as at a particular date. For example, if the closing date of the financial year of a particular company is 31st December, then balance sheet will report assets and liabilities and equity of that company as at 31st December 2020 or 21. The third statement is cash flow statement, and it reports the cash consequences of transactions by type of activity for a period of time. Essentially, it records cash payments and receipts. Not all the transactions are based on income. For example, a business sells some goods, it doesn't mean that the cash will actually come in. Business sells goods on credits. Similarly, business purchases raw materials on credit. So cash flow statement depicts what is the actual liquidity position of the company. So it organizes the transactions by type, and these are as we discuss later, are operating activities, financing activities, and investing activities. Moving on, overview of the basic contents of financial statements. Once again, very important. First of all, we will talk about income statement. Remember, this is the format of income statement where we will first list all the revenue items, for example, sales, and for example, the sales, then commissions, then fees earned, professional fees earned. Then we subtract the expenses, and then we arrived at net income, which is, as you can see, uh, revenue minus expenses. So the closing balance of the net income uh, goes to statement of retained earnings, as you can see. Okay, this closing balance goes to statement of retained earnings. And let's talk about the excuse me let's talk about, sorry, the key uh, elements of income or net income statement. First of all, we list the revenues. And what are revenues? What is the definition of revenue? Revenue is inflows in exchange for providing goods or services. Whenever a business sells its goods and services, the consideration it receives either in cash or in kind is called revenue. And when do we recognize revenue? Revenue is recognized when it is earned. For example, when goods are delivered or services are performed. I mean, regardless of the fact that the cash is received immediately or not, revenue is recognized when you have performed the services or delivered the goods. For example, sales, fees, commissions, rent, interest, these are all revenue items. Talking about expenses, uh, the definition of expenses is primarily concerned with Let me just use it. Yes. So talking about expenses, the definition of the expenses is outflows representing resources consumed in providing goods and services. Now, whenever, of course, uh, we produce goods, we need resources. For example, raw materials. For example, electricity. For example, labor. These are all the expenses which are used while while producing goods and services. So when do we recognize revenues? The principle of revenue recognition is matching principle, and this states that expenses should be matched to the revenues they help to generate. Okay, to the revenue they help to generate. Now, for example, cost of goods sold, salaries and wages, and amortization and depreciation. Now, let's move on to statement of retained earnings. And what is statement of retained earnings is that it starts with the opening balance of the retained earnings, as you can see. Then we add net income for this year, and then we deduct the dividends paid. Now remember that these net income figure, it comes from statement of retained earnings, and then of course when we add net income to the opening balance and deduct the dividends, we come to the ending balance of the statement of retained earnings. And remember that ending balance goes to balance sheet in the equity section, as we will discuss in a moment. Now, statement of retained earnings, all the net income from prior years, that is opening retained earnings, less all the dividend paid out in prior years, minus then if we subtract all the net income from prior years with from all the dividend paid in the prior years, we arrive at opening balance of statement of retained earnings, opening balance of retained earnings, and then we add this year's net income and deduct this year's dividend, we arrive at closing retained earnings, closing balance of retained earnings. So it is the profit that is retained or is kept within the business for future growth. Remember, not all the profit of the business is divided or distributed to the shareholders in the form of dividends, because some of it needs to be retained for future growth. For example, company wants to open a new chain, or it wants to expand its factory, so this some of the portion is retained in the business for future growth purposes. So balance sheet, now we will talk about balance sheet. Remember, the balance sheet primarily constitutes of assets, and assets always equal liabilities plus owner's equity or shareholders equity, because assets are financed by two modes. Either we borrow the money from banks, that is in the form of liabilities, or the owners contribute it by through shareholders, through shares. Okay, so there are only two modes of financing the assets, either through liabilities, which is by borrowing from banks, or by owners contributing to the business. So this also is essentially the basic accounting equation which we will be talking about shortly. Accounting equation is basically assets equal to liabilities plus capital or equity. So remember, balance sheet is prepared as at a point in time. It's basically a position statement. It's not a performance statement. Performance statement is income statement. Position statement tells us what is the position of the business as at a particular date. Moving on, this is the how a balance sheet, typical balance sheet looks like. First of all, on the left side, we state the short term assets, then we list the long term assets, and then we add both these, we arrive at total assets. In on the right hand side, first state short term liabilities, then we list all the long term liabilities, we sum both of these and we arrive at the total liabilities, then we add the equities portion to it. Remember, in the equities portion, the balance in the equities portion comes from statement of retained earnings, which we prepared a moments ago. Now, when we add liabilities and equity, the answer, for example, 100 would always equal the sum of the assets. And remember, if this is not the case, then you need to look into the financial transactions which you have recorded. There is always a mistake, because if all the things in the double entry entries are recorded correctly, then assets must always equal liabilities plus equities. So as you can see, the assets on the left hand side are divided between short term and long term assets, whereas the same is the case on the right side with liabilities. They are divided between long term and short term liabilities. The two sides of the accounting equation represented by the balance sheet must balance. That is, assets equal to liabilities plus equity. Basic accounting equation. What is the rationale behind this? Is that assets are financed either through liabilities or through the owner's own contributions. Key elements of balance sheet are: number one, assets. What are the key characteristics? They have future economic benefit. For example, if you have a machinery, you are taking advantage of it in the current period, but it will also be used for the next, for example, 10 to 20 years. So they have future economic benefit. So attributes are that assets are controlled by the entity, usually owned but not necessarily by the entity. For example, it's clear that assets are being controlled and being utilized by the company, but it's not necessary that assets are utilized or owned also. For example, business can be using an asset on lease, but assets on lease are not the ownership of the company, but nonetheless the company is using those and controlling those assets. And assets may be tangible, for example machinery, or intangible, example legal rights, patents, copyrights. These are all intangible assets. So examples of assets are these. On the left hand side you can see the examples of short term assets, which are cash, accounts receivables, inventories and prepaid expenses, whereas on the right hand side you can see long term assets which have a useful life of more than 1 year, which are factory, buildings, property, licenses, franchises, patents, investment in other businesses. Liabilities are also an essential element of balance sheet, and the key characteristics are that they are owed to third parties. Remember, the money which we owe to the owners is called equity. Liabilities are all those monies which are owed to third parties, that is, not the owners, not the shareholders. Okay. What are the attributes? They are due at a future date. You have to pay those at a future point in time. Of course, they can be long term liabilities which you have to pay for more than one year in the future, or they can be short term which you have to pay within 1 year. They may be settled in cash, goods or services. For example, if you have taken a loan for 1 lakh, 100,000, either you can pay that in cash, or you can, let's suppose, perform some accounting functions for that entity from which you have borrowed. So when you perform accounting functions, or even you can, if you're a maker of furniture, for example, then instead of paying the lender's cash, you can deliver them furniture, and that will be good enough to settle the liability. Examples of short-term liabilities are on the left-hand side, which are accounts payable, salaries and wages payables, accrued liabilities, and taxes payable. On the right-hand sides, we have long-term liabilities, which are loan payable and mortgage payable. Key elements of a balance sheet. Third one is equities. Equities are also called owner's equity or shareholders equity, and the key characteristics are that they belong to the owners, not the third parties. That is, owners are shareholders in the case of a corporation or company. Attributes are that they are not equal to the value or worth of an enterprise, because enterprise can be more than what the equity represents. Because for example, if a company, or Apple, we can say Apple company, its value is more than the shares, because when the shareholders originally purchased it for 100 rupees or dollars, and then as of now that the price of that equity might be, for example, $2,000, because Apple is worth more because of its brand loyalty and because of the premium prices it charges on its devices. So, and equity does not represent that it must be equal to the value of the business, and it is paid out to shareholders most commonly as dividends or retained in company for future economic growth. So as we just discussed, that not all the profit of the business is paid out in the form of cash, some is retained in the business for future economic growth. And it's made up of share capital, that is common shares, and retained earnings. When we sum up retained earnings and initial capital, then that is the though that collective figure is called equity share or shareholders equity. Now, talking about statement of cash flows, as you can see, it is bifurcated into cash flow from operating activities, then cash flow from investing activities, and then cash flow from financing activities. Operating cash flow from operating activities includes cash from selling your goods or services. From investing activities, it includes cash from you. If you sold some equipment, then the cash which you receive is listed in the investing portion of the statement of cash flow. And if you raise some loan, then it will be listed in the financing activities of the statement of cash flows. Now, this when we sum all these portions, it equals to the net cash inflow or outflow for the current period. Then we add the beginning cash, as you can see, and then we then we if we add these, we end up with the closing cash balance. And remember that these three heads, operating, investing, and financing, indicate cash receipts and cash disbursements by the entity for the period. And they are organized into three activities because the international financial reporting standards require us to do so. And as you can see, the last box, the closing balance of the cash flows goes to the balance sheet under the current assets head. Cash from bank, you can see, or cash flow, or the cash account. The sum of the cash account and cash from bank is actually over here, ending balance of the cash flow statement, and it goes to the balance sheet. Now, an MCQ for you: an entity's income statement reports the cash consequences? No. The results of operations for a specific period of time? No. Remember, income state okay, this can be the answer, but we'll come back to it later. But first, discuss C and D. The entity's financial position? No. Income statement is not about financial statement. Revenues, expenses, and the resulting profit for a point in time. Remember, income statement is not about a point in time, it's about a period of time. So the answer is B. How are financial statements interconnected? Number one, income statement to balance sheet? No. Income statement to statement of retained earnings to balance sheet to cash flow statement? Well, let's come back to it later. Number C, income statement to statement of retained earnings to cash flow statement to balance sheet. Well, let's come to it later and talk about it. Balance sheet, of course not. Financial statements do not start from balance sheet. So the most likely answer is C, because balance income or financial statements start from income statement, and then the closing balance of the income statement, which is net profit or loss, it goes to statement of retained earnings, and the closing balance of statement of retained earnings, from there on, we prepare the cash flow statement before preparing balance sheet, because for getting the cash or bank account balances, we need to prepare cash flow statement, and from therein we extract the cash and bank balance, and from statement of retained earnings we extract the closing balance of the equities and we put them into the balance sheet. So this is the sequence which needs to be followed in order to prepare the financial statements. So an MCQ for you: how much does the company currently owe to its suppliers? And the user is most likely to find the answer by looking at number one, income statement. No, because how much a company owe to its suppliers, it's a what is the nature of this account? It's a liability account. Okay, and where do we find liability accounts? We find them in the balance sheet. So that's the answer, number C. Preparing financial statements. Now that you understand of why external users require financial statements, that is to make resource allocation decisions, you need to know how to produce the statements. A deep understanding of the format of the financial statements will aid you in future chapters, of course, to in the future lectures to prepare as to how financial statements are prepared. So how to prepare financial statements? Regardless of how the information is provided to you, Always start by reading the list of accounts and categorizing them into different categories. Ask yourself, is this account an asset, liability, shareholders equity, revenue, or expense accounts? Remember, these are the five accounts which are involved in any transaction, and you need to ascertain as to a particular transaction is affecting which of these five accounts. And remember, each transaction will affect at least one of these accounts, at least sorry, two of these accounts, because we are looking at a double entry accounting system, and in double entry accounting system, at least one of these will be affected, at least one of these. It can be more than one. So once you have figured out, preparing the financial statement is simpler, since each category only goes into one financial statement. Let's see if you know which accounts go into which category. Inventory belongs in which category? Remember, inventory is an asset, so it goes to asset category. Income tax payable belongs in which category? Remember, income tax payable is a liability, so it goes to liabilities account, as you can see. Cost of goods sold belongs in which category? Remember, cost of goods sold is an expense, so it goes to the expense category. Let's go back to the accounting equation. The two sides of the accounting equation must balance. As you can see, assets equal to liabilities plus equity. Now you can see this equality is reflected in the balance sheet. Can also be viewed as assets equal to liabilities plus equities. Or alternatively, the wisdom behind this, the logic behind this is that assets are what is controlled by the entity, okay, and the assets are financed either by the third parties, for example, bank loans, or by the owner's interest, that is shareholders equity. So for example, if we have $100 assets, how we can finance them? For example, we can finance them by $30 of loan and $70 of the owner's equity. So that's why this equation always needs to balance. So which of the following is the correct way to rearrange basic accounting equation? Asset equals to liabilities plus shareholders equity. Yes, this is true. Shareholders equity equals to asset minus liabilities. Of course, when we when we take the liabilities on the other side, it becomes assets minus liabilities and it equals shareholders equity. So B is also true. Liabilities equals to assets minus shareholders equity. This is also true. And so the answer is essentially D, which is all of the above. Applying the basic accounting equation, okay, so we can find the missing figures by using this basic accounting equation. Now just brainstorm it in your brain, in your mind. If assets are $100 and liabilities are $600, then what would be shareholders equity? Of course it would be $1,000 minus $600, which is $400. As you can see, it's $400. What is the ending amount of shareholders equity? As you can see, so if the equation works on the balances at the beginning and of the period, then it also has to work during the year too. So say we say the following. For example, if the assets are 1,000 and liabilities are 600 and shareholders equity is 400, what would be the ending of the year balance if during the year assets increased by $250 and liabilities decreased by $100? Let's see. Assets, we added 250 in 1,000 and it became 1,250, and in liabilities, because liabilities decreased by $100, we subtracted 600, minus we had subtracted 100 from 600 and it became 500. Now the revised shareholders equity balance would be 1,250 minus 500, and it's 750. Yeah, here you can see in this figure the answer in the white is 750, and now you know how we arrived at this figure. So if we are only given some information, it is important that we know in which category the information goes. Say we start the year as follows. For example, at the start of the year, assets were 1,000, liabilities were 600, and equity was 400. Now, what would be the ending balance if shareholders' equity, if net income was 250 for the year and dividend paid were $50 for the year? Now, as you can see, that assets were 1,000, opening assets were 1,000, and opening liabilities were 600, and opening equity was 400. Now we can see that both income statement and dividends are part of the statement of retained earnings, and they both affect equity account. So what we will do is we will add 225 to the opening equity balance, which is 400, and we will subtract dividend of 50 rupee $50 from $400. So the answer would be 575. So I hope you learned a lot about financial accounting, as to what constitutes financial accounting, what are the ingredients of financial accounting, what are the elements of each of the financial statement which we prepare, and what is the accounting equation. And let's stay put to this video lecture series. Subscribe to the channel, because I'll be sharing more on financial accounting and uh, a lot of stuff about accounting and finance, and how to there will be a lot of things about accounting and finance. So do subscribe Bear Bull channel, which is a new channel, but of course it will help you in many ways. Thank you guys.